Let me ask you, is the stock market a meme? Because we're seeing something completely different right now. Retail investors are driving the stock market with speculative trading, leading to fear of missing out, using margin debt levels that are comparable to the 1990s, which what happened at that time? The dot-com bust. But who cares though, because new all-time highs is a good time, right? The S&P 500 closed out at a new all-time high today, reaching its 9th all-time high in just July, ending every single day this week at a new all-time high. The NASDAQ 100 at its 13th. And if we're keeping tallies, this is the biggest tally in almost 5 years, but Bitcoin's had a pretty rough day, going as low as 114,000. Really looks like it giving up on this 119.4 line that I got. But all of this euphoria in the stock market, at least, and low VIX, the volatility measure, being under 15, all of this is on trade deals coming in, earnings, and a resilient economy with retail buying up stocks. And so far, 80% of reporting companies have top forecasts coming in higher than the historical pace of 67%. But what will become more important going forward is, what do these companies have to say about future expectations? What are their forward guidance looking like? What do they expect the future to look like as far as forward looking comments? Goldman Sachs seems to think, based on their measure that they watch, it's called their speculative trading indicator that tracks the stock market risk, is at its highest levels since both the dot-com bust and the pandemic era, which are looking back to where these bubbles were that eventually popped. But right now, they do still see more room for this meme craze to continue running, and there's meme stock trading. There's options being really popular right now. More bets that the Magnificent Seven is going to continue carrying this rally and allowing that tide to lift all ships in the broader stock market. So people are just placing their bets, leading there to be this belief from Goldman Sachs that this bubble still has room for more air to allow that bubble to inflate in size. Now, let's look at this piece, because right now we're wondering why is the stock market still going up, giving all of the risks on the table? And especially the tariff risks, which we've seen how fast the stock market could drop. And now that we're facing them, and like next week, we got a big catalyst because August 1st comes in. Why did the stock market just keep on going up? And especially the S&P 500, new all-time high every single day this week. So let's look at this piece. And it explains and explores why. So it's by Mr. Jacob Sonnenschein. The stock market's gain is puzzling. Thank the short squeeze. So there's your hint right there. And it goes on to talk about why stocks are gaining so much given the tariff risks. And the major explanation that they have is that heavily shorted stocks, so bets that these stocks will fall, so they're shorting these stocks, have caused intense buying pressure. Traders shorted them by borrowing shares and immediately selling those shares, betting that the prices would fall generally within 6 months or so they could buy the stock back, profit on the difference, and return them back to the owner. So think about it. You get this stock at 80, you immediately sell it for the 80, and then, like, let's say you think that stock's going to go down to 40. All the owner of the stock wants is their stock back. You want to sell it at 80 and give it back to them at 40 and make that $40 spread. So they want to profit on the difference and return them back to the owner. When the entire market rallies, as it has been, short sellers fear these stocks will jump, prompting them to buy shares back before they rise too much, because it's like, oh, the stock's not going down to 40, it's going up to 120, so I'm losing money. I got to pay them to take their stock back pretty much. So they want to get out of that before it rises too much and they lose too much money. And price surges putting even more pressure on short sellers to buy, and that is what's called a short squeeze. And we've seen this back during the pandemic era where AMC and GameStop jumped to phenomenally high levels completely out of nowhere. And it was due to just that helping bring the market higher. And when stocks are memeing up, think about it. That's a sign of real euphoria. And there's this saying that, or this historical, they look back historically and they say that whenever there's this euphoria around memeing up in the stock market, it's a sign that we'll see above average returns in the 3 to 6 to 12-month time frame. Just don't be the last one out, because once you get closer to that 24-month time frame where you're 24 months out, that's where things get a little bit different as far as a return basis goes. And to really amplify those returns, that's where margin comes in, because people like using leverage to help them make more money. Because when you're able to borrow money and put it into stocks, that allows you to make more money, and then you could pay off your loan or keep it and just pocket the difference. There's a lot of cool ways people try to make more profits out there, but it's in the face of taking on more risk. And data from FINRA shows that margin debt balances in investors' accounts topped $1 trillion in June, reaching a new record like back in 1999, that dot-com bust. And remember, this dot-com bust, there are still people scarred from that. Like, I'm a little young, and a lot of investors my age, we weren't even alive back then. Yeah, we could look at the charts, but we didn't live through the scare that caused. And it's a bit worrisome when you think about it with this margin debt being at these levels, because it's all good when you can buy high and sell higher. But when lower highs start happening and lower lows enter the chat, lower lows have entered the chat, imagine trying to get out. And everybody tries to get out at once. But for now, we're still chugging along. And what will really depend on how the market continues to feel, because right now it seems the trend's up and it's memeing and everything. It will be the data. It will be trade deals and continuing earnings reports, as long as in addition to forward guidance and what these companies are saying. Lost my train of thought. But right now we got some pretty good data coming in that shows that the economy is still pretty resilient. Right here we see that nearly half of voters rate the economy as good or excellent under Trump, with 47% of surveyed Americans feeling the economy as good or excellent. And then on top of that, this one's a little mixed up, so let's get into it. This is durable goods orders here in the US, and durable good orders fell 9.3% in June. And stick with me. This was mainly due to aircrafts. And if you subtract that out, if you subtract those planes out, the durable good orders actually rose 0.2%. And yeah, we've seen this 9.3% decrease, but economists seen an expected 11.1% drop coming in due to the weaker orders over at Boeing. We've seen core orders fall by about 0.7%. Shipments of core rose by 0.4%. So overall, with today's durable good manufacturing shipments showed that the manufacturing side of the economy is still holding up pretty steady despite the negative headline that we've seen. And regarding trade talks, because that's another piece of the puzzle that everybody's watching, Trump gave us some more clarification as to what we could watch out for leading into next week, starting as early as Sunday, with Trump expected to meet the European leader in Scotland on Sunday. So I believe that, yeah, the European Commission president is who he's meeting over with in Scotland. And Trump seems pretty positive about these negotiations going pretty well. European Union already hinted at what the rate they're looking at, which they're eyeing that 15%, just like Japan got. But Trump said that there's this 50-50 chance, maybe less than that is what he said, word for word, but a 50-50 chance of making a deal with the European Union. So I'd imagine if we look back at the stock market and with it being super happy, like the European Union is huge. It's literally huge, and it's one of our largest trading partners. So 15% on them, that's a slice of cake in a way, right? But on the other hand, we also heard about Canada. And what Trump revealed with Canada is that negotiations probably aren't going so well with Canada. And Trump said that Canada may just get a tariff, not necessarily a negotiation, because they're not here to negotiate. They don't want to talk with a level head, is how Trump's making it seem. So that's kind of what we got as far as news today and this week and what to watch out for next week. So we already hinted at some of the stuff to watch out for next week, but it doesn't end there, because we're going to get more stuff regarding trade deals, because the August 1st deadline is Friday, like I mentioned. And then on top of that, we got a busy week as far as the economic calendar goes, because we got advanced U.S. trade balance in goods, retail inventories, wholesale inventories, Case-Shiller home price index. How's the real estate sector holding up in May? Consumer confidence, job openings in June. We're expecting them to come in lower than that of May. So they were 7.8. We're expecting a drop in 7.4. But what's been the trend with the jobs lately? Better than expected, to the upside. Then Wednesday, we got ADP employment, which we went from a negative read on that to now expecting a positive 82,000 in July. We got GDP, pending home sales, the FOMC interest rate decision. We already know they're not cutting rates unless something just terrible happens between now and Wednesday. But the Powell press conference question section, the Q&A section of this press conference, is what a lot of people are going to be watching. A lot of the questions that Powell's going to be asked, which I'm sure he's going to try to keep it as boring as possible, but it doesn't end there, because then we get initial jobless claims. Remember, that's weekly that these come out. The PCE, so the Personal Consumption Expenditures Index, which is the Fed's preferred measure of inflation. We went from 0.1% increase to a 0.3% increase. I'd imagine most of this is going to be tied to the cyclical nature of the summer heating up and more people doing more spending and traveling around in the summer, on top of that of tariffs. Then Chicago Business Barometer PMI, which we're expecting to see an increase, but it's still in contractionary phase according to forecasts. And then the U.S. employment report. That Friday is the day to watch, because the job report and the August 1st deadline with the tariffs and what those rates will be for the countries who haven't negotiated yet. And we're not going to get China. That they're going to get an extension from their August 12th deadline, it seems likely to be. But for now, aside the data, there's no denying that momentum is the key right now, that everything's just going to keep on momentuming up on optimism, earnings, and AI. But margin debt and speculation creeping in leads to question of how strong the foundation really is in the markets and in the economy overall, because they all play a piece in one another. So come back next week. Let's see what the data reveals, what the headlines show, because what's driving this rally could be what ends it. I'll see y'all next week.